We never want to sell our real estate properties, and that's why we have buy, borrow, die. We never sell. When we sell a real estate property, we have to do depreciation recapture, we have to capital gains taxes. It's all brutal and it completely destroys our overall return on investment. Okay. So we have a few options when we're talking about buy, borrow, die, right? We initially buy the property, we cost seg it, we take all those losses like we've been talking about over the last few videos against our income. We borrow against that property through what's called cash out refinances, okay, allowing us to pull our debt back up to the 80% loan to value. And this is tax free. This is what's so substantial is when you take a loan out on a property, you do not pay taxes on it. That's why all the big wigs in real estate like Grant Cardone and all these people are saying they want to die with $1 billion worth of debt because you don't pay tax on that debt. You can have a $500,000 home, and if you have a huge amount of equity in it, you can do a cash out refinance, pull $100,000, $200,000, $300,000 out of that home in cash. The bank will give you cash and you do not pay tax on it. It doesn't even go on your tax return, which is substantial because you can take that $300,000, you can go buy more real estate properties with it and generate more losses with it and take more losses against your income without even having to pick up that debt on your tax return, which is substantial. You can snowball your wealth so fast and so quickly by doing this strategy. So that's what we do with cash out refinances, and debt is not taxable. Huge thing to remember here. Now, when we die, you get what's called a stepped up basis. Okay, so what your basis is the basis for a property is basically how much you were into that property. So for example, if you were to buy a property, let's say you purchase a property at $300,000. Your basis in that property is $300,000. If you pay cash for that property, if you have a loan on that property and you're personally responsible for that property, your basis in that property is $300,000. As you depreciate this property, let's say we've depreciated this property by $100,000. Okay, your basis in that property is now $200,000. What that means is when you get a stepped up basis, you get to step up this basis to the fair market value at the date of death. So let's say you depreciate this entire property. You've owned this property for 40 years and you've depreciated the entire property. Okay, so let's say you have depreciation equal to $300,000. Okay, now your basis in this property is zero. Okay, if you were to turn around and sell this property, you would have a huge, let's say you sell this property for $450,000. You're gonna have a capital gain equal to $150,000. You're also gonna have what's called depreciation recapture equal to $300,000. Meaning your total gain in this property is $450,000. Okay, now your capital gain tax rate is going to be taxed at least within this year, which is 2022, taxed at 20%. But then your depreciation is going to be capped at 25%, depending on how you took your depreciation. So that's a lot of tax. That's a massive amount of tax on that property. Okay, but what happens when you get a stepped up basis, if we get rid of all this and you actually get a stepped up basis at the time of death. So let's say you die, and when you die, your stepped up basis is equal to $450,000. Your kids can turn around and sell it that day for $450,000 and not pay a dime in taxes on it. What they can also do is they can go back into this and re-depreciate it. So they can then do depreciation again, cost seg it, do all the depreciation again, take those losses if they want to continue with the real estate property and depreciate it again. So there's a lot of benefits that come when you die. I know you're dead, but it goes to your kids with a very, very strong tax benefit to it, okay? So along with this, there's going to be times where you have properties that you want to get out of that are not performing, and you want to get out of those properties. So if we shift gears and talk about that here for a second, how you get out of those properties, okay? And it's called a 1031 exchange. Okay, now how 1031 exchanges work is it's a real estate for real estate. Okay, so you can sell a raw piece of land for a single family home, roll it into a multifamily home, multifamily into commercial. It's real estate for real estate. Okay, so it's very substantial. There's a lot of flexibility with how you can do 1031 exchanges. Now, how a 1031 exchange works is, let's go back to our original example. We have a purchase price of $300,000, and let's say we've depreciated $100,000 of this. So our basis in this property is equal to $200,000. Now let's say we have a sale price equal to 450,000. We now have a capital gain, or we now have a gain of $250,000. And what this gain is made up of is we have capital gain of 150,000, which is our difference in 300 and 450. Okay, and we also have depreciation recapture equal to $100,000. Now, how we avoid having to pay taxes on those is through what's called a 1031 exchange. Because instead of having to pay tax on this $250,000 gain, we're actually going to roll this up into a new property of equal or greater value. So let's say, for example, we have a new property with a purchase price equal to $500,000. We're going to roll up our gain of $250,000. Our original basis in this new property, $250,000. So we have a basis in this new property of $250,000. So what this means is if we were to turn around and sell it the next day, we're going to have to recapture everything that we just did, right? Because our starting basis is $250,000 in this new property. Now, same thing goes with depreciation. If we were to go and do a cost segregation on this property, our starting basis is $250,000. That's where we get to start our depreciation amounts on. Okay, so that's something to keep in mind. Now, going back to our original sale here, if we have $200,000 of equity built up within this house, so let's say we've owned this house for a long time. We have a lot of equity built up. We can sell it for $450,000 and we can walk away with a couple $100,000 worth of cash. That can actually be your down payment on a new property. And if you can get into a new property with a 10 to 20% down payment, you could potentially get into, I don't know, what, $1 million property. And now that basis reduction of whatever the old gain that you're rolling into that property, it becomes less substantial. So you can really, it's a simple game of Monopoly when you really think about it. 3 greenhouses equal 1 red hotel. Right? Simple game of Monopoly when you're doing 1031 exchanges. Now, this is how we always continue the process of buy, borrow, die. We never truly sell. We're buying properties. We're buying new properties into our portfolio. We're 1031 exchanging the old properties that aren't working well. We're borrowing against the properties that are working well within our portfolio. And then when we die, we get a stepped up basis. We pass to our kids tax free. This is why real estate is by far the strongest investment that you can do when it comes to tax savings. I don't know of any other tax savings tool out there that has so many jam-packed benefits to it. And honestly, it's why all the wealthy people out there and those who have extreme wealth have a large real estate portfolio, because somewhere down the line, they started investing in real estate to reduce their tax liability, and it also goes to their kids and their heirs tax-free. Thanks for tuning in to this overall discussion about real estate. Next, we're going to be jumping in to oil and gas, talking about oil and gas investments, why those are substantial and why they're important. Thanks, guys. Looking forward to it.